Amazon.com Inc. is currently trading at $259.67 per share, reflecting a slight intraday dip of 0.07% during this April 30, 2026 session. While the broader indices are grappling with a bit of volatility, Amazon is effectively holding its ground after a massive earnings-led surge. This price point is particularly interesting because it sits just below the 52-week high of $275.17 we saw earlier this morning, showing that while the bulls are in control, there is a clear battle happening at these elevated levels. You might look at a slight red day and think the momentum is fading, but the reality is far more complex. Most people expected a typical post-earnings fade, where investors lock in profits, yet the volume we are seeing today suggests institutional players are actually stepping in to absorb the selling pressure. This creates a fascinating tension because the market narrative suggests Amazon is a retail giant, but the data is screaming that it has become the ultimate infrastructure play for the next decade. If you have been watching the tape, the movement lately has been nothing short of aggressive. Just a few weeks ago, the sentiment was cautious. People were worried about retail margins and how the company would handle rising logistics costs. Then the first quarter results hit the wire and everything changed. Net sales jumped 17% to over $181 billion. That is not just a beat, that is a statement of dominance. Most of that came from the AWS segment, which grew 28%. This is the fastest growth rate they have seen in nearly 4 years, and it's happening on a revenue base that is already massive. When a company this big starts accelerating its growth, it forces every portfolio manager to reevaluate their exposure. If you are using investing sites to track your performance, you have likely noticed that Amazon has outperformed almost every other megacap peer over the last 30 days. The common belief right now is that the retail side of the business is just a low-margin necessity to keep the brand alive while the cloud does the heavy lifting. I want to challenge that perspective. While AWS is certainly the profit engine, the retail segment just hit its highest unit growth rate since the post-lockdown era. They delivered over 1 billion items on the same day or overnight in the first few months of 2026 alone. They are automating the entire recruitment and logistics process using internal systems like Connect Talent and Connect Decisions. This is not just about selling books and electronics anymore. It's about building a physical and digital network that is impossible to replicate. When you look at your individual brokerage account, you have to ask yourself if you are buying a store or a sovereign-level infrastructure provider. Let's talk about the AI side of this because that's where the real money is moving. While some competitors are fighting over which chatbot is smarter, Amazon is busy building the factory that powers all of them. Their custom chip business, featuring the Trainium and Graviton series, has topped a $20 billion revenue run rate. This is growing at triple-digit rates. They are not just buying chips from others, they are designing their own to ensure they have the best price performance in the industry. The demand for Trainium 3 is so high that it is already nearly fully subscribed for the year. This is a massive shift in the business model that most casual observers are missing. They see Amazon as a place to buy groceries, but the institutional activity shows that the big players are treating this as a semiconductor and data center play. Recent daily swings have been driven by a mix of macroeconomic pressure and sector-specific momentum. We're seeing a lot of rotation out of pure-play software and into companies that own the actual hardware and power. Amazon's capital expenditure plan for 2026 is a staggering $200 billion. To put that in perspective, that's more than the entire market cap of many S&P 500 companies. They are spending this on data centers and AI infrastructure because they already have customer commitments for it. This is not speculative spending, it is fulfilled demand. If you are using interactive brokers for high-speed execution or more advanced trading strategies, you've likely seen the volatility around these CapEx announcements. The market initially hates the spending because it eats into free cash flow, but the long-term investors realize this is how you build a moat that lasts 50 years. The institutional activity has been particularly telling over the last week. We have seen significant inflows from some of the largest pension funds and asset managers. They're looking at the 13.1% operating margin and realizing that the efficiency gains from AI are finally starting to hit the bottom line. Even though the net income of $30.3 billion was helped by a one-time gain from their investment in Anthropic, the underlying operating income was still well above what anyone anticipated. This is why the stock is sitting near all-time highs despite the broader market being a bit shaky. Whether you are using the Robinhood app for its simplicity or managing a more complex portfolio through Fidelity Wealth Management, the trend is clear. Amazon is no longer just a participant in the market, it is the market. Comment below how many shares of Amazon stock you currently hold, or if you are waiting for a pullback to add to your position. I'm curious to see how many of you are long-term believers versus short-term traders on this one. For those of you focused on self-investing, it's important to understand what the company actually does at its core today. It is a three-headed monster. You have the retail side, which is increasingly automated and efficient. You have the advertising business, which is now a $70 billion annual revenue stream and growing faster than almost any other part of the company. And you have AWS, which provides the backbone for the entire internet and the burgeoning AI economy. They are even making moves into media that are paying off, like the massive success of their recent film Project Hail Mary. This diversification is their greatest strength. If retail slows down because of consumer spending, advertising picks up the slack. If advertising softens, AWS carries the load. This is a level of resilience that you just do not find in smaller companies. Looking at the future outlook, the scenarios for the rest of 2026 and into 2027 are heavily weighted towards the upside, provided they can execute on this massive infrastructure build-out. The main risk is that the capital spending doesn't translate into immediate revenue growth, which could lead to a period of stagnation for the share price. However, with the current pace of AI adoption, that seems unlikely. The catalysts to watch are the continued ramp-up of their custom chips and the potential for a Prime Day surprise in the second quarter. They have already guided for net sales between $194 billion and $199 billion for the next quarter, which shows they have high confidence in the consumer. If they can maintain these margins while spending at record levels, the valuation could expand even further. If you are looking for investment help or trying to decide between different investing sites, it's worth looking at how Amazon fits into a broader tech portfolio. It often trades in tandem with names like Apple stock or Nvidia stock, but it has its own unique drivers. Unlike a pure hardware play, Amazon has a recurring revenue model through Prime and AWS that provides a floor for the stock. If you are using Schwab Intelligent Portfolios or a similar robo-advisor, you've likely already have exposure to this name because it is a staple of almost every growth-oriented fund. The key is to manage your position size so that you can weather the inevitable volatility that comes with a high-growth tech stock. In terms of the platform you use for your online investing, whether it's SoFi Invest for its active trading features or a traditional Fidelity brokerage account, the tools available now to analyze these daily swings are better than ever. You can see real-time institutional flow and track how the sector momentum is shifting. Right now, the momentum is clearly favoring the infrastructure providers. Amazon has positioned itself perfectly to capture this. They aren't just selling the shovels for the AI gold rush. They own the mine, the transport, and the store at the end of the road. The reality of the situation is that Amazon is in the middle of a massive transformation. The expectation was that it would slow down as it reached a multi-trillion-dollar valuation, but the reality is that it is finding new ways to grow. The contrast between what people thought was a mature retail business and what is actually an AI powerhouse is the primary reason the stock has so much runway. We have moved past the point where we can judge this company by how many packages it delivers. We have to judge it by how much of the world's computing power and digital data it controls. To wrap this up, the central insight here is that the market is finally beginning to price Amazon as a diversified technology and infrastructure conglomerate, rather than just an e-commerce platform. The results from the first quarter of 2026 have proven that they can grow their cloud business and their retail business simultaneously while maintaining record efficiency. The record capital expenditure is a sign of strength, not a sign of desperation. While we might see some sideways movement as the market digests these gains, the long-term trajectory remains compelling. Expectations suggested a plateau, but the reality is an acceleration that most analysts didn't see coming. Whether you are using a Fidelity trading platform or a Robinhood stock trading account, keeping a close eye on these infrastructure developments will be the key to understanding where this stock goes next. The authority in this space belongs to those who control the physical and digital rails of commerce, and right now, that is undeniably Amazon. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, outshare with your friends, bell subscribe for more updates.